Every country buying oil is also, invisibly, buying American debt. The petrodollar system is one of the most powerful and least understood financial arrangements in modern history. Most people have never heard the name, yet petrodollar mechanics shape mortgage rates, inflation, foreign policy, and who wins wars. Understanding the petrodollar system requires going back to one of the worst financial crises the United States ever faced. By 1971, the United States was running out of gold. President Richard Nixon unilaterally ended the Bretton Woods Agreement, severing the dollar's link to gold entirely. Without gold backing, the dollar needed a new foundation, something universally demanded, globally traded, and impossible to ignore. Henry Kissinger found the answer in a commodity everyone on Earth needed: oil. In June 1974, the United States and Saudi Arabia signed a broad bilateral agreement covering military protection, arms sales, and economic cooperation. A secret parallel arrangement, not revealed until Bloomberg filed a Freedom of Information Act request in 2016, committed Saudi Arabia to invest billions in oil revenues into U.S. Treasury bonds. Saudi Arabia agreed to price all oil exports in U.S. dollars, and that pricing model quietly spread across the entire OPEC bloc. The petrodollar system was not written into international law, and no global vote was ever held. The petrodollar system worked because every major oil producer calculated that dollar pricing served their own national interests. Now, consider what dollar oil pricing actually means for every other nation. Japan, Germany, South Korea, and India, countries with zero domestic oil supply, must first earn US dollars before purchasing a single barrel of energy. That structural requirement creates permanent global demand for the US dollar, regardless of American economic performance. The United States can print dollars, spend them abroad, and watch foreign nations scramble to earn those same dollars back through exports. Economists call this structural advantage exorbitant privilege, a term coined by French finance minister Valéry Giscard d'Estaing, who recognized American monetary dominance decades before most governments did. Exorbitant privilege means the United States can run chronic trade deficits without the currency collapse that would destroy any other economy. Petrodollar recycling is the second engine of this system, and even less visible than the pricing mechanism itself. When Saudi Arabia, the UAE, or Kuwait sells oil for dollars, those countries accumulate enormous dollar surpluses far beyond domestic spending needs. Those surplus petrodollars flow back into U.S. Treasury bonds, American real estate, Wall Street equities, and global financial markets. Petrodollar recycling is the reason U.S. interest rates stay lower than American deficit levels would logically allow. Foreign central banks, sovereign wealth funds, and oil exporters collectively buy American debt, suppressing borrowing costs for U.S. households and businesses alike. The system also benefits oil-importing nations, which hold dollar reserves as a stable, liquid global asset. The petrodollar system is, in short, a self-reinforcing loop. Oil exporters earn dollars, invest dollars, stabilize the dollar, and thereby justify pricing the next barrel in dollars again. But one geographic feature has repeatedly exposed the structural fragility of this loop. The Strait of Hormuz is a narrow channel, at its tightest point, only 33 kilometers wide, connecting the Persian Gulf to the Arabian Sea. According to the U.S. Energy Information Administration, approximately 20 million barrels of oil per day transit the Strait of Hormuz, equivalent to about 20% of global petroleum consumption. The Strait of Hormuz has been closed or credibly threatened multiple times in modern history: during the Iran-Iraq War in the 1980s, during nuclear standoffs in 2012, and again during escalating conflict in 2026. Each closure demonstrates the same structural vulnerability. 20% of the world's oil supply passes through a channel controlled by a single hostile coastline. The Strait of Hormuz is not just an oil choke point. It is a recurring stress test for the petrodollar system itself. When oil flow through the strait is threatened, oil prices spike globally, dollar demand shifts unpredictably, and petrodollar recycling slows. The geography of the Persian Gulf means this vulnerability is permanent. No political agreement fully eliminates it. Meanwhile, the largest oil exporter on Earth has been quietly repositioning. Saudi Arabia chose not to formally renew its exclusive dollar pricing commitment in June 2024, a date that passed with almost no mainstream media coverage. The Saudi government has since built the technical infrastructure to settle oil trades in yuan, completing a 50 billion yuan currency swap agreement with China's central bank. Saudi Arabia has also joined the Enbridge digital payment platform, which processed over $55.5 billion in cross-border transactions by November 2025, according to Atlantic Council data confirmed by Reuters. On the Enbridge platform, China's digital yuan accounts for approximately 95% of total settlement volume. Russia, under Western financial sanctions after 2022, accelerated yuan and rupee settlement for eastward oil exports, turning de-dollarization from theory into operational practice. India now buys discounted Russian oil in rupees. China settles growing volumes of energy contracts in yuan. The BRICS bloc is actively designing shared payment infrastructure designed to bypass the SWIFT dollar system. The critical nuance most analysis misses: de-dollarization is not a single event. In 2015, approximately 98% of global oil transactions settled in US dollars. By 2025, that figure had declined to around 76%, a significant directional shift, but not a collapse. De-dollarization is better understood as a gradual erosion of dollar exclusivity, a shift from monopoly to oligopoly in global energy payments. The direction of travel is now unambiguous, even if the pace remains slower than headlines suggest. So, what actually breaks if the petrodollar system fractures significantly? First, demand for US Treasury bonds would decline, pushing American interest rates higher and making government debt substantially more expensive to service. Second, the US dollar would weaken against commodity-backed currencies, raising the cost of imports for American households. Third, oil-importing nations holding large dollar reserves would face valuation losses, creating political pressure to accelerate the very de-dollarization that caused the problem. Fourth, a multi-currency oil pricing system would introduce currency risk into every single energy trade, raising transaction costs for buyers and sellers globally. The most likely replacement for the petrodollar system is not a single alternative currency, not the yuan, not a BRICS token, and not a return to gold. The most probable outcome is a fragmented system: dollar pricing for some markets, yuan pricing for China-aligned buyers, rupee and ruble settlement for specific trade corridors. Fragmentation reduces the efficiency of the current system without delivering the stability and depth of any single replacement. The petrodollar system has survived 50 years because replacing it requires more than a new currency. Replacing the petrodollar system requires a new military guarantor, a new, deep financial market, and a new web of trust among dozens of sovereign nations simultaneously. No single country, not China, not a BRICS coalition, has yet assembled all three components at once. The dollar's continued dominance rests less on any formal agreement today and more on the sheer depth of US financial markets, dollar liquidity, and the accumulated inertia of half a century of global habit. The petrodollar system is cracking. It is not collapsing. Understanding the difference between a crack and a collapse is the most important financial literacy question of the next decade. What do you think? Will Saudi Arabia fully pivot to yuan oil pricing within the next 10 years? Or is the dollar more durable than the current headlines suggest? Drop your answer in the comments. Serious reasoning is especially welcome down there. The next World Stages video takes on a system that touches every government on Earth, how central banks actually control your money, and why the decisions made in one building in Washington can raise your rent, kill your savings, and reshape entire economies overnight. Subscribe to World Stages so you don't miss it. The next video is dropping very soon.